This is the United Podcast Network.
Welcome to Spouses Talking Houses with husband and wife real estate team Jennifer and Brian Frost. Everything you want to know about buying, selling, investing, and owning property. So let's get real about real estate.
Welcome back to Spouses Talking Houses. I'm Jennifer.
And I'm Brian.
And together we are going to get real about real estate. Today we're going to talk about vocabulary and lingo, particularly since I think it's kind of easy for us to start throwing terms around in front of buyers and sellers and they don't know what we're talking about.
Sometimes I don't know what we're talking about. Just kidding. We know everything we're talking about.
We know everything we're talking about. It's just sometimes you will be thinking something in your head and you'll start talking to me about that or this and I'll have no idea
Hey, that goes both ways.
what the subject is.
Yeah, it goes both ways.
Yes, that's what happens when you're married and you're in real estate. So speaking of the real estate lifestyle, I'm slowly watching most of our garden wilt and die and our grass die. It's so dry.
Is that the way you're looking at it?
That's the way I'm looking at it, yeah.
That's depressing.
I know.
I don't look at it that way. I look at it as, wow, I harvested so many tomatoes this year and
Oh, absolutely.
I finally just set up my first chipmunk trap.
Oh, dear.
I shouldn't have said that. I'm sure I'm going to offend somebody, but not that I would think of killing them.
It's a humane trap.
Of course it is. Well,
no.
They've gone too far.
It's not that. So Brian is like Elmer Fudd, and he's at war with the critters that will eat our produce.
I have not got a pellet gun yet.
Thank goodness. Yeah. Your vegetable garden is absolutely gorgeous.
The pandemic garden.
The pandemic garden. My two driveway beds that I'm supposed to weed look like hell. Can I swear on my own podcast? I guess I can. And then my climbing hydrangea is just dying in the heat, as it does every August.
Well, that's not true. It hasn't rained in 2 months. Come on, what do you expect? How many lawns have you seen that really look great?
Not many.
Not many.
Many. Yeah, we've shown a lot of actually high-end properties in the lawns.
Yeah, the lawn
dormant.
looks no better than mine, and I'm like, oh, I don't feel so bad.
The lawns were dormant. There are parts of your lawn that could use some help.
Yeah, but I don't care.
Oh, okay. I thought you told me you were going to redo it.
Lawns are not normal anyway.
This is true.
Some English guy came up with that and brought it over. And well, he's probably dead now.
All right, yeah. By the way, we recorded this right after our rant episode, so we're in a mood. Okay. So one of the things that I often correct you on in regards to vocab is you start emailing and talking to people about comps. And I say, Brian, they don't know what a comp is. Yeah.
What is a comp?
Well, would you like to explain it, sir?
I just asked you.
I think I asked you first.
A comp is a sale or a listing of a property that you think is similar to the property that you're comparing it to. So
it's a comparable property.
Right.
Yeah.
So it's just an abbreviation, comp.
Right.
Which, obviously as an appraiser, we use that also. And yes, so you're right. Sometimes just as you do with me.
I'm not perfect, disclaimer.
Yes, I do tend to, abbreviate sometimes and just figuring that my client is going to know what I'm talking about, and that's not always the case. But I have been better lately. I've been,
I'm training you.
CMA, I spell it out, it's comparative market analysis, and this is what it is. It's similar to an appraisal. It's not an appraisal.
Yeah.
We do use a similar method, but so I'm getting better at that.
Yeah. So CMA is one that gets used a lot, comparative market analysis, and also MLS. MLS is the lifeblood of our business because that's the database of all the listings. But if you don't know that, you're like, what are they talking about? So that is the multiple listing service. Realtors can put in their listings in order to share them with other realtors, and that's how the photos and the data get fed to all the real estate websites. Right. Is through our MLS system, our multiple listing service.
Yeah, and the MLS is going to generally have the most accurate data.
Yeah. And then the MLS system, by us putting the properties in there, we're agreeing to cooperate with other brokers. So that means that you can call your agent about anything you see in MLS. You don't have to be calling 100 different agents.
Right.
Yeah.
You definitely need to be in MLS if you're selling a property.
Oh, I absolutely
Right.
agree. Yeah. Yeah. So let me see what else we have here. So appraisal, so what's an appraisal as opposed to a CMA?
Well, an appraisal generally is done for a lender. I mean, they can also be done for privately, but generally, it's a valuation of a property based on an analysis. There's three approaches to value. There's a sales comparison approach, there's a cost approach, and there's an income approach. Single-family properties, mostly you're going to be hanging your hat on the sales comparison approach, that's what's similar to a CMA.
Right.
So,
the data that you're using is similar.
right. So
Yeah.
for a CMA, comparative market analysis, that is done by an agent or a broker, they are, they're evaluating the market and they're pulling comps,
Yes.
similar properties that are either listed or recently sold, and they're comparing it to the subject property to come up with an estimated list price or forecasted list price or forecasted sales price, whatever the case may be. And they may or may not do adjustments to the comparables, the
Right.
comps.
Yeah.
And you really don't have to support don't really have to support your opinion.
Right.
Whereas in an appraisal, you do have to support your number. You have to support adjustments.
Yeah.
You can't just say, "All right, I'm adjusting this at $20,000
I felt like it.
because I know that's
Yeah.
what it's worth."
Right. Right.
So it's a lot more detailed and holds a lot more weight, frankly. Well, obviously it depends on how good the appraiser is.
Well,
but-
in New Hampshire and Mass, appraisers need to be licensed.
Of course. But I mean, it's the same with a CMA. I mean,
Right.
CMA can be good depending on how experienced and
Yeah.
the agent is too.
Well-
or how well they know that particular market, neighborhood, whatever the case may be.
And the appraisal will have stricter standards about, calculating square footage,
Sure.
what's considered above grade, what's considered below grade, and that type of thing. Whereas a market analysis can be as simple as the agent just gives you a list of some addresses and what they sold for.
Yeah, and we
you
think
know.
we should list your property at $400,000.
Right. Right. So the CMA can take any variety of formats, and like you said, they don't have to justify the analysis part where the appraiser does. Yeah.
In most cases with the CMA, I prefer to do a full, what we call an adjusted CMA, where I am actually applying adjustments as if I was doing an appraisal. But in that case, I'm still not defining how I got to those adjustments or why I'm doing those adjustments.
Right.
I just put them in there.
Right.
And when I'm doing a CMA, I am wearing my real estate agent hat.
And not
I
your
am
appraiser hat.
Not my appraiser hat. And I also try to make it, the clients realize that that's the case. Like,
Right. Yeah.
even though I am an appraiser, this is not an appraisal.
Right. An appraisal report is a different
Exactly.
report. Yeah.
And we don't always agree. I mean, I'll do
You and I?
Yes. I mean, I'll do a CMA sometimes.
And then I will correct it.
And you'll go, well, that's not a very good comp.
I
I'll
wouldn't
go,
use that.
Wait a minute, that's a good comp. No. Anyway, so sometimes you want to add comps or you know what? And generally, I'll admit that I probably tend to be a little more conservative on my CMAs than
I have no problem with that.
than
Yeah.
most agents.
Yeah.
And I realize that too.
Yeah.
So, and you realize it.
And I realize that, yeah. And we warn our clients of
Sure.
that as well. Some buyers and sellers will also ask me, so what's the difference between the inspection and the appraisal? So the inspection is the home inspector being hired almost always on behalf of the buyer to check the property condition and look for, are things operating? Are they safe? Are they structurally sound? That type of thing. And so that report goes to the buyer, and then hopefully the buyer is also present during the inspection and they get educated about the house. The appraisal is usually ordered on behalf of the lender to certify the value of the collateral for the loan, and that report goes to the lender.
They are the client of that appraisal.
They are the client, yeah. So the appraiser is in the house usually 20 minutes, and the inspector is usually in the house 2 hours
or more.
or more. Yeah.
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 So the other thing is that appraisers often get sued by buyers.
Often?
Let's not
Sometimes.
let's not say often.
Okay, sorry.
I was thinking more on a national basis.
Okay, yep.
Okay. Appraisers will sometimes get sued by home buyers, because the septic fails a year later,
Oh, and that wasn't your job.
and they think that the appraiser should have known
Right.
that the leach field was
Right.
not in good condition. What they don't understand is that an appraisal is not a home inspection.
Right. Right.
So, I put a disclaimer in my appraisals that specifically outlines I am not a home inspector.
Yes.
I'm not looking at any hidden items in the house. I can't see behind the walls, et cetera, et cetera, et
Yep.
cetera. So,
Yeah. Same thing with our listing agreement and our buyer agency agreement with our clients. It says, we are marketing people. We are licensed real estate agents, but we're not attorneys. We're not tax accountants. We're not home inspectors. We're not mortgage lenders, et cetera.
right.
Yeah. So we have to stay in our lane.
What we generally like to do is if they ask a question that's outside our realm that we shouldn't be
Talking about.
commenting on, we
Yeah.
say, all right, here's a site that you can go look at to get this information. Or we suggest that you go talk to a structural engineer about the
Exactly.
crack in that foundation
Right.
because,
Right.
I have a feeling I know what it is, but,
Right. I'm not an engineer.
I'm not professionally qualified to
Exactly.
determine what that is. So.
Yeah. We get asked a lot about closing costs, particularly since sellers have closing costs, buyers have closing costs. Sometimes buyers ask the sellers to contribute towards their closing costs. So for the buyer, the closing costs are really focused on obtaining the loan. So that will be, you've got your down payment, but then what are you paying the lender as far as originating the loan?
Fees, yeah.
What are you paying for the title search, the title insurance? Then you have something called prorations. So proration is the sellers have paid taxes through October 1st. You're closing in September. You're going to prorate a couple of weeks' taxes back to the seller. There's a condo fee that's paid to the first of the month, and you're going to prorate that and share that. The other thing that gets that's part of closing costs are escrows. So there's a tax bill that's going to be due in December in most of New Hampshire, and if you are closing in September, you're not going to have an October 1 payment. You're going to start your payments November 1. So you're only going to have made one payment by the time that that is due. So that you really have to escrow 6 months or more because there's a 2-month cushion in your escrow account. So closing costs is just saying all the lender fees, all the transfer taxes, all of the escrows, all of the prepaids, all in one lump sum. For the seller, the closing costs are typically going to be a transfer tax in both New Hampshire and Massachusetts called tax stamps in New Hampshire. It's going to be your real estate commission and preparation of the deed, maybe some wiring charges to wire funds and recording of the deed, some miscellaneous charges there. But there's a lot fewer total charges on the seller side than there are on the buyer side. But you thought of something. I saw your eyes light up.
I just forgot one of my pet peeves.
Oh, yes.
And that is the disclosure of closing costs in MLS to help out the appraisers.
Oh, yes.
So,
yes, this is controversial,
and
actually.
then the lazy answer is, oh, my company does not allow us to disclose closing costs.
Do you know that we work for a company that doesn't? That has a policy of not disclosing
and
closing costs?
that's why I don't put them in the listing. But
if anybody calls me, I'll tell them.
Somebody calls me. I don't consider it confidential information.
I don't either.
I consider it a main part of the deal, and I also consider it. I want to get the numbers right. So
Well, this brings me to another pet peeve.
we already did that.
We
one.
already did pet peeves.
But anyway, so
Yeah.
I mean, if a house has $20,000, well, that's high. We'll say $10,000.
Yeah.
So a $200,000 house that has $10,000 in closing costs. I mean, that the seller's paying.
Right.
The net sales price on that property is $190,000.
And
But the lender wants me to bring it in at $200,000.
that was going to be my pet peeve.
And the agent doesn't want to tell me about the closing costs because that might hurt the deal.
Right.
And
Right.
but it's my job as an appraiser to contact every one of those agents
It is.
and try to
ask
figure
the
out
question.
to
Yeah.
ask the question. I'm just doing my job.
Yeah.
And 90% of the agents, whether their company policy is to allow it or not to disclose the closing costs, most agents are good about it.
Yeah. So we won't go further into that right now, but I will say, so when a seller contributes towards the buyer closing costs, we call that a concession. So that's another vocabulary word.
Yep.
A seller concession, right?
Sure.
Yep. Contingencies in a contract. Contingencies would be a buyer is saying, I will buy this subject to satisfactory inspection. That's a contingency. Financing. That's a contingency. I'm going to buy this subject to there being clear title. That's a contingency. So that's what that word means. And then on your loan commitment, okay, so there's another vocabulary word. On your loan commitment from your lender, they're saying, hey, we've approved you for a loan, and there will be something on there called conditions. And so the conditions are things like you still need to be employed at the time that you close.
That'd be helpful.
Yeah, and you didn't go out and buy a couple of expensive cars and totally change your debt structure.
That's actually happened to us a few times, right?
We haven't gone all the way to closing with that, but I did have it happen once in between offer
what do you mean
and
you
home
bought
inspection.
a car?
Yeah, exactly. And then they no longer qualify for the loan.
Exactly.
It wasn't my buyer, by
We
the
can
way.
always live in the car.
It was my listing, but it wasn't my buyer. So, so those are called conditions, and we call that a conditional loan approval or a loan commitment. So, we talked about escrow, mortgage insurance. So there's a couple of different types of insurance involved when you purchase a property. So one is you've got your homeowner's insurance that protects the property against fire and other damage, okay? Sometimes called hazard insurance. Then you have mortgage insurance if your loan is less than 80% of the value of the house, or more than, I should say. So let's say you're 5% down and you're borrowing 95%. The lender will want protection for their exposure of that additional 15% between 80 and 95. And so they will get private mortgage insurance on that loan, and that's an additional fee. It's also known as PMI. And a lot of times buyers will come and go, I don't want to pay PMI, so I want to wait till I have 20%. PMI is not evil in and of itself, but it is expensive. All right, we should do a podcast on PMI. If you get an FHA or a VA loan, you are getting an insured loan, but it's not private mortgage insurance. It's FHA insurance or VA insurance. And then the other type of insurance that you get would be your title insurance. So title insurance protects the deed that you have full ownership of that home, subject to hopefully, just your mortgage lien at that time.
You want to make sure it's free and clear so you don't run into a problem down the road.
And when you run into a problem down the road, title insurance is supposed to help you cure that,
Right.
or give you the value of the property that you.
Right, because something
Right.
can slip through the cracks.
Exactly.
So
Exactly. And then another type of insurance would be a home warranty. So home warranty is an optional program that you can get that will cover the major mechanicals of the house for a year at a time. You can buy extended warranties too. And, they'll cover things like the furnace and the air conditioning unit and appliances and well pump, but they're not going to cover your roof. They're not going to replace your septic system. So it's really just mechanical type of items usually.
sure.
Yeah. Yeah.
REO.
REO, real estate owned, which also means foreclosure. And so a foreclosure property with the lender, it was an asset, I believe, a receivable on their books when it was a loan and they were receiving money every month, and then the house was collateral. And then once they foreclose on it, it becomes real estate owned on their books, and that's where the abbreviation came from.
And then it's listed on Zillow as immediately available.
Yeah, no, that's pre-foreclosure.
Oh, I'm sorry.
Which just means there was a notice of default that somebody got behind on their payments, and that property is not yet bank owned and not on the market.
What do you mean I can't go look at that
And
property?
the price on Zillow is false. Yes. Okay.
Short sale goes along with that.
Oh, so short sale, there's nothing short about it, first of all. It takes a long time. But the term comes because that owner is short as far as having the money underwater, having the money to pay off the loan. So let's say they owe $400,000 on their loan, and the house is really only worth $360,000 in the market. You can apply to your lender to do a short sale, where basically you would say, if I need to get out of this house. So you have to have a hardship, and your hardship is usually that you've lost a job, there's been health issues, you need to move out of the area because of a job. You can't just be like, I don't feel like owning this house anymore.
You basically have to show that you really can't pay your mortgage.
Yeah, and you have to show that you don't have the income or the assets to carry the house or to make up the differential.
Right.
And then you need to prove that the market value is less than what you owe. And then we need to get a buyer to buy the house. And then we need to get approval for the short payoff. And this takes months.
Yeah, it's a long time.
It's a long time. It takes months. We can definitely do a whole
and
you
always let our clients know that that's the situation, and they have to be ready for that.
They have to be ready for that. Yeah.
It's not for everyone.
Yeah. And so some people will say, maybe I don't want to buy a foreclosure property because of all this other stuff, but really they're discussing a short sale. They've heard things about short sales. To buy a foreclosure, once the bank owns it, is actually really pretty straightforward and easy.
Sure.
Yeah. Yeah. I guess we should mention auctions then as well.
What is it, Hubzu?
Yeah, exactly.
Your
That's my favorite site.
But sure, yeah.
But we had an episode on auctions. So when somebody usually purchases a property, they're doing it by contract. And purchase and sale agreement, contract agreement, they're all pretty much mean the same thing. Whereas an auction is something where you're bidding and then you're following through to purchase at auction. And a lot of times that's an as-is property. You might not have been able to get into it. We go into more detail on that on the episode that we did on auctions.
All right. What about underwriting? I mean, it's done, on every loan.
Yeah. So underwriting is when you make a loan application, you're going to deal initially with a loan originator, and then it's going to go to a loan processor. But the person who makes the decision to approve the loan is the underwriter. And so underwriting means that's the process where they're going to say, hey, we think that you can repay this loan over the next 30 years, and we're going to give you a couple $100,000.
Sure.
So it's funny how sometimes it's easy when you think about it in that respect, and other times it's hard when you think about it.
Yeah, and the underwriter is also scrutinizing the appraisal.
Absolutely. So. Yeah, they're looking at the borrower as well as the collateral.
Sure.
Yeah. So the closing disclosure is the form that tells the borrower what their total costs are going to be for the loan. So that's the closing costs, the monthly cost, the costs over the life of 30 years, what the interest rate is on the loan, and then what it actually turns out to be, over the life of the loan, and if you include all the other costs. So that's a federally regulated document. So I should also mention the ALTA statement.
Sure.
So the ALTA statement you get at closing, and that, I don't know, it's probably American Land Title Association or Association of Title, whatever.
If you say so.
If I say so. I don't know. I'm making it up. So that shows the money in the transaction, the seller side and the buyer side at the transaction, so that you understand exactly what all the adjustments are and what cash is being brought to closing, and then what cash the seller is going to bring away from closing. Equity. You want to explain what equity is?
Equity is basically the profit that you have in a property.
Yeah. Yeah. You owe a certain amount and it's worth a certain amount. And so that's what you could pull out of it.
And the market goes up, you pay down your mortgage. You bought a house $300,000 a couple of years ago and the market's gone up and you've paid off some of your mortgage. So now it's worth $350,000.
Right.
And so you've got some significant equity.
You've got equity. And your equity is not liquid. So you don't have access to that money unless you either sell the house or you take a loan against your equity.
Yeah, you could do a refi or cash out refi.
Cash out refi, yeah.
Take a vacation.
Put
your kid through college.
Yes, that's a good idea. A reverse mortgage is a mortgage where usually an older retired person who doesn't have income but owns their house outright, they can actually take out a mortgage where instead of them sending a payment in every month, they receive income every month. And so the principal balance on the house is increasing as they receive those payments versus what we would do if we were paying down a mortgage.
Right.
Yeah. So we should also mention amortization. So amortization is how your principal and interest are applied on a loan. On a 30-year loan for a mortgage, that's pre-calculated in, and so your first payments, you are paying more interest and less principal, and then your last payment, you're paying more principal and less interest. And if you pay additional every month, once a year, you decide to pay biweekly, you can reduce your principal, and that will change your amortization. It'll re-amortize, and your total interest will go down.
Sure, and you can take off many years off the loan as well.
Exactly.
So that you could pay it off, a 30-year loan, you could pay off in 20 or 25 years, depending on how much you contribute.
I've always just rounded ours off
by
the next 100 or two, and so that's taking payments off the end.
Sure.
And we are getting near the end actually on ours. We have 5 years left.
So I think a good thing to explain would be the APR versus the actual interest rate on a loan.
Yeah, if I could explain it, but
okay.
I kind of just did.
I know you did.
I kind of just did. So the interest rate. Let's just say your interest rate is 3%. Your APR is going to be a little higher than that. It might be like 3.15 or something like that, because they're going to take anything else that you're paying into or towards that mortgage as far as your origination costs and your closing costs. And then so you could pay what they call discount points. And you could say, I'm going to pay an additional 1% or 2% of the loan amount, and I'm going to get this down from 3% to 2.75. What you'll see is that your APR is still going to be higher because all you did was prepay some of your interest.
Right.
So your APR is a way for borrowers to be able to compare interest rates if one lender is saying, oh, here's this rate with 2 points and here's this rate with 0 points.
Right.
And then here's another rate where we actually give you a lender credit towards your closing costs. Oh, another pet peeve of mine. There's no such thing as a no closing cost loan, in my opinion. There are loans where the closing costs are paid with a lender credit.
I hear those ads on the radio all the time.
So, yeah, I know. I don't know if I'm right or wrong, but I'm firm in my belief that there's no such thing as a no closing cost loan. Because there are closing costs. They're just being paid by the lender credit.
Right.
Yeah. All right.
I have to agree with that.
You have to agree with that. Now I'm going to try to quiz you on something. Oh, you're going to know this one. What's adverse possession?
Adverse possession is a situation where a person occupies a portion of your land openly for 20 years. They can claim that they actually own that portion of the property. If you have, the owner has not either given them notice or talked to them saying, hey, that's my property. I know that you're using it for...
Yep.
But I'm just letting you know because I know about adverse possession, and I don't want you to take ownership of that portion of the property.
Yeah. So if somebody basically for 50 years had a fence in a field that it turns out later overlapped, if they had continuously used that land and there was never any conversation between the two that said, hey, by the way, this is mine, and this is mine,
Right.
then it could actually just become absorbed into that person's land.
Exactly.
Yeah. Doesn't happen often, but it's the type of thing people will quiz us on, and
Sure. I mean, it's we have a lot where we have a situation where our main lot is set back from the street, but we do have a small portion of the lot that's up by the street that's cleared out and that our neighbors use openly.
Yeah, it's closer to their property than ours. Yeah.
There's been a swing set. They store their boat on that.
Yeah.
But we're both aware of the situation. So
Yeah, we're all aware that
Right.
it's technically
it's
our
our
land,
property,
but they use
and we
it.
don't mind that you're
Yeah.
using it.
Yeah.
Right. Exactly.
So that would not be adverse possession,
But
because
if
there's
w-
been conversation
But I'm
about
just
it.
saying, if we had never had a conversation, or if we
Right.
bought that property and we didn't realize that
Right.
was our part of our land, and then
Right.
20 years later we found out that it was,
Right.
they might have a
claim.
claim to that
Yeah.
that portion of the property. Yep.
That, by the way, would be a title issue.
Yes,
And
it would.
title insurance, yes. Do you want to quiz me on one? I'm
Uh,
going to say Brian got 1 point because he got that right.
okay. What is external obsolescence?
Oh, I knew that's an appraisal term, so of course you know that well.
Well, as a realtor, you should know what that is.
So an external obsolescence would be something about the exterior of the property that is old-fashioned and no longer really functional or applicable. Am I close? Not even close.
External obsolescence is something that happens off the property.
Oh, external to the property.
Right.
I
So
get it.
power lines or
Yeah.
a gas station next door.
Yep.
That property next door that's a junkyard that's not supposed to
The
be.
hoarder house.
Yeah,
Yeah.
exactly.
Your
Okay.
neighbor's got roosters.
Exactly. It could
Roosters, yeah.
it could be any of those items. So, all right.
Okay.
1-0.
I think it's yeah. I think it is 1-0. What's an appurtenance?
An appurtenance. I know what this is. This is a. Yeah, can I see that? Oh, okay. Yeah, an appurtenance is something that's actually attached to the property. It's considered real estate and not personal property.
Right. Exactly.
All
Yeah.
right.
All right.
I
You
knew
might as
that-
well. You might as well talk about what personal property is too.
Sure. Well,
And a fixture, because they're all related.
Sure. A personal property is examples would be above ground swimming pools, sheds, refrigerators, washer and dryers. It's generally any item that you can remove from the property that doesn't cause damage to the property would be considered personal property. Fixtures are they're more related to commercial properties, hotels, furniture, fixtures, and equipment.
Okay.
Which are also actually personal property, but because they're not affixed to the property.
Okay. To me, in residential, a fixture would be like a light fixture.
Oh, a light fixture.
I don't know. Anything that's affixed.
Okay.
Anything that's affixed to the property, or like
Well-
a wood stove is hooked
Well, a
up.
light fixture it's real estate,
Okay.
right?
I don't
Because
know. You tell me. You're the appraiser.
Well, if you pluck it off the ceiling, there's going to be damage
There's
there.
gonna be damage.
So,
Okay.
and we've had the switcheroo
Yes.
with light fixtures and refrigerators
Yes.
and.
Yeah.
Not doesn't always go over well. You buy a new house and you walk in and you go, oh, right, wait a minute, where's that where's that beautiful chandelier light
Chandelier,
fixture? And that's not the same fridge that was here when we came
Yeah.
through.
So that's the type of stuff I negotiate and make sure we're clear about in a contract. This is a good one for you to explain. What's a capitalization rate?
I have no idea. No,
I just gave you an easy point.
I know. It's a discount rate that's applied to determine value. You divide it into the sales price to come up with an overall rate. And it's as simple as that.
Okay, so I thought it was something that investors use to decide how much they should offer on a property.
Well, true. I mean, yeah, so they're analyzing what the overall rate is.
The rate of return.
Rate of return, that's different. But,
Okay.
Well,
I'm confused.
they're all
That's all I'm
connected.
saying.
Okay. Capitalization rate is the income divided into the sales price that gives you that rate.
So if I was looking at a multifamily for $300,000
Yeah.
and the gross income was or the net income
was 30.
was 30 grand.
Then you're looking at 10%.
Then I'm looking at 10% cap rate.
Which everything in the 80s and early 90s was a 10% cap rate, no matter what. But
and now it's much lower, isn't it?
Cap rates are much lower now.
Because interest rates are lower.
Right,
so,
of course.
You know, people are going where they can get a return on their investment, right?
Yeah, depending on the property condition and type of property, they can vary.
I get asked this one a lot. What's the difference between a condo and a townhouse? And there are two different terms. So a condo is a form of ownership, which means that there's some sort of common land. It could be a common building, but either way, there's some group ownership of some underlying property, and then you own a unit within the condominium association. I don't know if people can hear Brian's ringtone. It's the Bruins fight song, whatever song you would call that.
It's Key Bank.
Key Bank is calling you?
Yes.
We don't have any accounts with them, so.
No.
Okay. I guess that's good news.
They could be calling me about an appraisal.
Right.
But, yeah.
So a condominium is a form of ownership. We can have condos that are detached structures. We can have condos that are townhouses that are attached. We can have condos that are duplexes where you get half. We can have condos that's like an apartment-style building and you have your own unit. A townhouse is just simply a structure where it's an attached layout, and then you usually have multiple stories, 2 or 3 stories. Am I correct?
I'm sorry, I wasn't listening.
You weren't listening. Okay. All right. Why don't you ask me one more, and then we could probably wrap this up.
Okay. I have to give you something that you won't know.
No, that's going to be pretty easy, I think.
Yeah, I don't think so.
You don't think so? Oh, a fixture, by the way, is an item that was once personal property but is considered a real property by attachment or legal addition.
Okay, thank you.
You're welcome.
Okay, what's a green area?
Or like green space? Okay. So to me, a green area would be in a condominium or a subdivision. It's a common area that is meant to be undisturbed. And and left natural. And so usually in the subdivision plan from the town or city, it's been designated as this is not going to be developed.
Or land area, a land area covered by vegetation.
Oh, agree, an area that's green.
Yes.
An area that's green.
Exactly. So.
When you brought up external obsolescence,
Sure.
that made me think we should talk about functional obsolescence.
Sure. Okay. Functional obsolescence is an example would be not having a bathroom on the first floor of a 2-story residence.
Yep.
Which was common back in the day.
Right.
But would be considered functional obsolescence by today's standards. Then you could also get into curable and incurable.
Oh, all right.
So
you're getting all fancy on me now.
Curable would be something that made sense to put the money into fix that obsolescence.
Yeah.
And incurable obviously would be the reverse, where it would make no sense to put in that amount of investment to cure. I'm trying to think of an example of what incurable would be, but...
Well, so one of the things I was thinking of that we see in older houses is you walk through one bedroom to get to another.
Oh, sure.
So that's a good example of both.
That's definitely functional obsolescence.
And it's pretty incurable usually.
Right. And another common one would be a lack of a closet in a bedroom.
Right. Yep.
So
in an older home.
Yeah, you see that all the time. And in most cases, obviously, that would be curable. You put in a closet or...
Right.
So,
yeah.
and so...
So something like that. We've got much more here, but I'm sure we've bored people more than enough.
Oh, sure.
For this particular episode.
All right, I won.
Yeah. That's always the way. Thank you so much for listening to Spouses Talking Houses and having us get real about real estate. We ask you to like, subscribe, and share, and return for more.
Music courtesy of the Eric Lindbergh Trio. Please visit his website at www.ericlindberghworld.com. Jennifer and Brian are licensed to practice real estate in New Hampshire and Massachusetts. Brian is also a certified general appraiser in New Hampshire. They are not lawyers, accountants, home inspectors, or therapists. Real estate customs and rules may be different in your area. Each Keller Williams Realty office is independently owned and operated. The Realtor name is trademarked to members of the National Association of Realtors. If you are currently under contract with a real estate agent, this is not intended as a solicitation. Views expressed on this podcast by Jennifer may not be shared by Brian and vice versa, nor are they necessarily the views of Keller Williams Realty.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21, Podcast Café, the United Podcast Network, its partners, or affiliates.